We had an expectation that Iran would be able to continue to place their barrels. I think what the market has been missing, though, with all the discussion about waivers is these countries have all made significant reductions. The countries that are receiving these exemptions will have to cut further over the next 180 days, and several of them are already close to zero. So I actually think this is pretty important for the market. I think the administration has been fairly successful in getting Iranian barrels significantly off the market.
So you're saying the fact that there are 8, I think, exemptions, which are big countries, that doesn't water it down?
No, there were 20 countries under Obama that got these exemptions. So they've done more than the Obama administration has. They are going it alone. If you had said in May that we would have lost 1 million barrels of Iranian exports before the sanctions kicked back in, that would be pretty bullish. I would say going forward, there's going to be a further round of reduction. So I think this is actually materially important.
So, John, explain then why, leading up to this decision, why oil prices are down 15% from the highs.
Well, I think there was a real fever in the market and a real fear that Helima rightly describes in terms of losing really what was thought to be all of the Iranian exports. The administration for a while there talked up a heavy-handed game saying they were going to use maximum pressure to get Iran to zero. The market kind of took them at their word, and so did Russia and Saudi Arabia, because they put a burst of oil onto the market in response to that positioning. Then all of a sudden we get these waivers. And then all of a sudden as well, you have a global economic slowdown that's occurring out there because of the high price that was generated. So it's sort of been a 1-2 punch for this market. It's been a litany of bearish news. The highest OPEC production since 2016, record Russian production, and the U.S. numbers got jacked up in a big way for August, going over 11 million barrels a day in the latest monthly report from the EIA. So a lot happening.
Who's the most important marginal producer now?
I mean, the most important countries to watch are what can Saudi Arabia do. Trump administration put a lot of pressure on Saudi and Russia to front load the production increases. The question is, what do they have going forward? Have they reached the near-term high? Again, the market is well supplied now, but as we go into further Iranian reductions, if we have any problems in any of their problematic producers, it becomes a question of, does this market tighten?
Chinese are not going to really stop buying Iranian crude, though, overall. I mean, you hear reports of unmarked tankers and things of that nature. Is that not true?
I mean, clearly the Iranians are turning off the navigational systems. But what I would say is Tanker Trackers has it, so does the U.S. government. We have satellite technology that we can use to track those tankers. I don't think there's any expectation that China is going to go to zero. But if they make any reductions, that's more than people initially thought they would do. We had a lot of hedge fund clients thinking that China was actually going to massively ramp up their purchases. If they make any reductions, that's important. India is very important. The Indian oil minister said in May, we're not cutting at all. They're now down almost by half. So going forward, it's going to be important to see who has to cut more into the next 180-day decision.
So add it all up, John, and how much income is Iran actually losing?
Well, they're getting cut in half, basically, on their oil exports. It's in the billions of dollars. This is going to squeeze them big time. And is
it going to work? Is it going to bring them to the table to renegotiate a deal?
It's darn close. I mean, that economy of theirs is teetering. As much as you see anti-U.S. demonstrations, there's plenty of anti-Iranian regime demonstrations as well out there that are on the rise, much more than I've seen in quite some time. But to Halima's point, Saudi Arabia, to me, is the key. After Election Day, I think they're going to be less incentivized to sort of do President Trump's bidding in terms of oversupplying the oil market. I can tell you this is the kind of price sell-off that registers with the kingdom, and they say, whoa, we're putting on the brakes here in terms of output, at least for a time. The Russians will keep going full out. Some of the others will, but watch the Saudis turn the dial back.
Is Khashoggi an important dynamic still, or no?
I mean, I think Khashoggi is an important dynamic for potentially congressional sanctions. I think the Saudi leadership does not want a further erosion in prices. So watch what happens over the weekend. There is an OPEC meeting taking place in Abu Dhabi, but the first one before we have the final meeting in December. And that'll be very important to see. Do they signal that they are going to put the brakes on this and potentially talk up the market a bit?
Well, you seemed skeptical when John said that he thinks the Iranians are going to come to the table for a deal.
I mean, look at the 12 conditions that Pompeo has laid out. That is essentially saying to the Iranians, you better capitulate in order to get these sanctions lifted. I think they are a long way from capitulating, so I think this is going to go on in terms of this economic strangling of Iran. I think it's going to be something we're living with for 2019.
John, I feel like every time we have max bullishness amongst the guests we bring on to discuss the future price of oil, it goes straight down every time.
A couple of months ago, there was so much talk about $100 oil. I said that it became conventional wisdom, which means it absolutely won't happen. So, yes, I mean, this is a market that gets, hot. And the narratives get hot. And the positioning then builds up markedly. I mean, we got to a record open interest in terms of long positioning, on the numbers David, not just talk. So, and now it's come out. And now the market's chasing out the hedge funds because of the contango structure. The prices in the front are lower than the ones in the back. Long-only commodity hedge funds get killed in that environment, so that's why you're seeing them come out.
Although hedge funds are net sellers of oil futures.
That's right.
Five weeks in a row here.
The ones that are starting to build a short position. But the speculative length, Sarah, that got built up is just got the legs cut out from them, under them because of the oversupply in the global market.
It feels like also this economic slowdown narrative is sort of winning the day over the geopolitical concerns.
No, I think that was really weighing on sentiment. I mean, the concerns about what was going to happen to demand in China, what is happening in emerging markets like India, what's happening in Turkey. I mean, I think those were the real bearish concerns out there in the market. So it's really been this sort of push-pull between the demand and the supply story in terms of fears.
And the rising dollar crushed these non-dollar countries and economies, India and the other emerging markets. You thought we were paying $75, $80. They were paying well over $100 a barrel, higher than when it was in 2008.
Bottom line, where are we going to be
translation.
at the end of the year on oil prices? WTI, John?
WTI, I see us around 75.
Helima?
Yeah, I see us back into the 70s for WTI and the low 80s for Brent.